Cable is painting a textbook trap right now, and over 70% of retail traders are about to walk straight into it. The pound has held its ground overnight, drifting sideways around 1.3378, absorbing no real selling pressure ahead of the single most important US inflation print this quarter. But while the herd is fixated on a clean breakout above 1.34, the smart money is doing something completely different. They are fading every weak rally. They are building short exposure against that exact level. And right now, the charts are flashing a structure that looks identical to every pre-CPI liquidity grab we have seen this year. There is one danger zone and one hidden opportunity right here. I'll show you both. And stay until the end, because I am giving you 3 exact levels you can trade tomorrow, complete with stop-loss placements and risk-reward ratios that actually make mathematical sense. Here is your instant market verdict. The session bias on pound sterling to US dollar is to fade rallies. We are range-bound to bearish below 1.3400, and sellers remain firmly in control while price stays trapped under the daily moving average cluster. The single level that flips everything, write this number down, is 1.3454. That is the daily resistance to and the exact point where the bearish structure resets. If we get a 4-hour close above 1.3454, the sellers have lost, the short squeeze is on, and I will flip my bias to a melt-up toward 1.3500 and beyond. But until then, every pop is a gift. Now here is the micro-insight that matters. The herd is heavily short just under 1.3400, and they have been riding that position comfortably, but the real vulnerability is the pile of buy stop sitting between 1.3410 and 1.3450. If CPI triggers a quick spike, those stops get run, the squeeze ignites, and the shorts get obliterated before the real move resolves. That is the trapdoor, and the professionals are positioning on both sides of that liquidity wall. Let's go deep into the charts, from the weekly canvas all the way down to the 60-minute execution frame, because that is where the money is hidden today. Starting on the weekly, the trend is a strong sell. Price has been making lower highs since the 1.3800 rejection 6 weeks ago, and the 20-week moving average is sloping down like a ramp right around the 1.3500 handle. The 200-week moving average is miles above us, no relevance here, but the 50-week moving average is flattening near 1.3650, acting as a magnet only if we get a fundamental shock. The MACD on the weekly is still in bearish territory, histogram deepening, no sign of a bullish divergence yet. Drop down to the daily, and the picture gets even darker. The daily trend is a strong sell. We are trading at 1.3378 right now, and look at where the moving averages sit. The 5-day moving average is at 1.3380. We are already below it. The 10-day is at 1.3394. The 20-day sits at 1.3427, the 50-day at 1.3457, the 100-day at 1.3443. And here is the killer. The 200-day moving average is resting at 1.3385. Price is below every single major daily moving average. That is a textbook bearish alignment. When you are below the 200, below the 50, below the 20, and the 20 is starting to cross below the 50, that is the dollar killer dynamic playing out in real time. The daily ADX is reading 21.9, which tells me the trend strength is building but not yet at extremes. Plenty of room for an acceleration move. The CCI is at -81, not oversold, which means there is ample space for this to fall further before any mean reversion trader steps in. The daily RSI is 43, bearish but not washed out. On the 4-hour, we have a developing story. The trend has softened to neutral, but that neutrality is the pause before the next leg. We have a bear flag forming, price coiling between 1.3330 support and the pivot point at 1.3371, with a ceiling near 1.3413. The 4-hour MACD is showing negative divergence. Price made a marginal low a few days ago, but momentum did not confirm. That divergence tells you buyers are exhausted on the rallies, not that they are gaining strength. It is a continuation signal in a downtrend, and most retail traders misread it as a reversal. That is what they miss. Now zoom into the 60-minute chart, where the 1-hour trend is a strong sell. Price is hugging the bottom of its short-term range, with the 20-period moving average sloping down and acting as a dynamic resistance every time price attempts a bounce. The 60-minute Williams percent range is at -65, confirming bearish momentum. The stochastic is at 37, pointing lower. There is no oversold bounce signal yet. The critical support zone starts at 1.3330, which is the daily S1 and the last line of defense before a massive liquidity void. Below that, 1.3288 is S2, and 1.3247 is S3. On the upside, resistance sits at 1.3413, then 1.3454, and the ultimate ceiling at 1.3496. Right now, the daily pivot at 1.3371 is acting as a magnetic level. We are oscillating around it, and it is the fulcrum for today's session. Here is what most traders miss. The cross with the euro is compressing as well. Euro to pound sterling is ticking higher, which means the pound is weakening against the euro at the same time cable is heavy. That is not a dollar story alone. That is sterling vulnerability. And when you overlay the 2-year gilt yield versus the US 2-year yield, the spread is widening in the dollar's favor again. The bond market is screaming that the Bank of England will be forced to cut sooner than the Fed, and that policy divergence is the gravitational force pulling cable lower. Now let's connect the fundamental driver to this price structure, because yesterday's news changed the playing field. Sterling held its ground overnight not because of UK strength, but because the market is petrified of front-running the US inflation number. The headline reads "Pound holds ground" ahead of pivotal US inflation print, and that is exactly the kind of sentiment that breeds complacency. What is priced in right now? The market expects a sticky core CPI, barely budging, which gives the Fed cover to keep rates higher for longer. That is a dollar-positive scenario. But the real risk is a hot print. If CPI surprises to the upside, rate differentials blow out violently, the dollar index rips through 105, and cable does not just break 1.3330, it free falls. On the other side, a soft print could trigger a dollar dump and a short squeeze towards 1.3450, but that move would be fleeting because the UK economic underbelly is soft. The Bank of England's recent dovish tilt, with Bailey hinting at cuts before year-end, is the sterling anchor. So my 1 to 2 week directional lean is bearish, targeting 1.3250, with an invalidation on a daily close above 1.3450. The exact event that can rip this view apart is the CPI release itself, a miss on core that crushes real yields. So, question for you right now, and I need you to comment. Do you think the dollar breaks 105 this week? Comment yes or no. I am tracking Consensus Live, and I will pin the best analysis. Now we are at the section most people skip. Do not skip this. This is exactly where the money is made. I am about to give you 3 precise trade plans for pound sterling to US dollar right now, covering the conservative sniper, the active trader, and the aggressor. Each one comes with exact entry, exact stop, exact targets, and the invalidation condition that tells you to step aside. Pay attention, the sniper, conservative plan. This setup is built for patience and high probability. We wait for the CPI dust to settle, but the framework holds anytime price retests the 1.3400 technical ceiling. The trigger condition is a 1-hour candle close above the pivot at 1.3371 followed by a sharp rejection, printing a long upper wick, ideally right at the 1.3400 to 1.3413 resistance zone. Entry is a sell limit at 1.3395. Your stop loss sits above the 4-hour demand zone and the recent swing high, right at 1.3458, just above R2. That gives you 63 pips of risk. Target 1 is 1.3330, the daily S1 and the level that will hold or break the structure. That gives you a 65 pip reward on the first scale out. Target 2 is 1.3290, just above S2 at 1.3288, capturing the liquidity void once 1.3330 breaks. That extends the reward to 105 pips, pushing the risk-reward ratio past 1 to 2.6. This setup is void if we get a 4-hour close above 1.3454. That is the invalidation. If that happens, The structure has changed and you do not want to be short the sniper, conservative, entry. 1.3395, limit on 1H wick rejection, stop loss. 1.3458 take profit 1. 1.3330 take profit 2. 1.3290 risk, reward. Tilde 1:2.6 are invalidation. Void if 4H close above 1.3454 the active trader. The standard plan. This is for the trader who wants to engage on the intraday rhythm without waiting for a perfect CPI spike. The setup is a break and retest of the intraday support zone after a failed bounce. The entry condition is a 5-minute close below 1.3365, confirming a break of the hourly pivot magnet, with a subsequent pullback to the 1.3375 to 1.3380 area that rejects the 20-period moving average on the 15-minute chart. Entry is a sell at 1.3375. Your stop loss goes at 1.3415, just above the hourly resistance level and the round number 1.3400, giving a 40 pip stop. Target 1 is 1.3330, the same key support, for a 45 pip gain, locking in better than 1-to-1. Once target 1 is hit, move your stop to break even and let the runner target 1.3288, the daily S2. That runner delivers 87 pips from entry, pushing the overall risk-reward toward 1 to 2.5 if both targets fill. The trailing stop rule after target 1 is hit. Trail your stop by 20 pips on the remaining position. This setup is void if price breaks above 1.3420 and holds, signaling a structural reclaim of the intraday bullish territory. Active trader, standard, entry. 1.3375, on 5M pullback after break below 1.3365, stop loss. 1.3415 take profit 1. 1.3330, move SL to B after, take profit 2. 1.3288 risk, reward. Tilde 1:2.5R, with runner, invalidation. Void if 15M close above 1.3420 and now, type your pound sterling to US dollar range for tomorrow right here in the comments. Let us see who is aligned. Give me your high and low, and I will read through the best projections, the Aggressor, high-risk plan. This is not for everyone. This is for the trader who can lose small, manage risk in seconds, and is willing to front-run the momentum before the CPI release or in the immediate aftermath. The entry is a market sell at 1.3375, right where we are hovering, with the assumption that the pre-CPI drift will continue to grind lower into support. Your stop loss is extremely tight, at 1.3405, just above the hourly resistance and the psychological 1.34 handle. That is a 30 pip stop. Target 1 is 1.3340, capturing the first friction point before S1. Target 2 is 1.3305, just above the S2 zone. This is a momentum chase on the strong sell 1-hour trend, with the ADX above 20 and the MACD accelerating lower. The risk is that any headline noise could spike price 30 pips in a heartbeat and stop you out. The invalidation is a 15-minute close above 1.3410. If that happens, you exit instantly, no questions. Only take this trade if you are comfortable with a 30 pip loss and you understand that CPI data releases are the most volatile minutes of the month. The Aggressor, high risk, entry. 1.3375, market, pre-CPI drift, stop loss. 1.3405 take profit 1. 1.3340 take profit 2. 1.3305 risk, reward. Tilde 1:2.3 are invalidation. Void if 15M close above 1.3410. CPI volatility risk extreme risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions held through high-impact news unless you are explicitly trading the release with a defined risk envelope. Stops are non-negotiable. A 30 pip stop is your shield. This is how you survive to trade the next big move, the next setup, the next quarter. Protect your capital like it is the only thing that matters. Because it is, here is the close. The single most critical level for the next session is 1.3330. A daily close below that level opens the trapdoor to 1.3250, and potentially a full extension to 1.3100 over the next 2 weeks. Tomorrow we will be dissecting the CPI aftermath live, the wildcard being whether the dollar index breaks 105 and whether the gilt treasury spread blows out another 10 basis points. That event could accelerate the sterling collapse or trigger the mother of all short squeezes. If you want the full breakdown on Bitcoin and the S&P divergence that is flashing a similar trap, that video is live right now. Tap the end screen. Smash like if this gave you a clear, executable plan. Subscribe, hit the bell, and I will see you in the next one with the levels that matter before the market moves.